Imagine a scenario where the titans of the crypto ocean, the Dogecoin whales, decide to double down on their bet, scooping up over 1 billion Doge. In a single 24-hour window, as prices slipped below the psychologically important 20 cents mark, a move that immediately captured the attention of traders and analysts, and raised the question, are the big players capitalizing on a dip to set the stage for a fresh rally? Or are they merely rotating capital in a market defined by its mercurial memecoin dynamics? On one side of the ledger, the on-chain data, courtesy of SANITMENT's supply distribution metrics and highlighted by analyst Ali Martinez on Platform X, reveals that addresses holding more than 1 billion Doge, equating to roughly $200 million, at current prices and with no upper cap, have reversed a recent trend of distribution and have instead embarked on a renewed accumulation spree, effectively increasing their positions by the same magnitude that they shed at the end of July. This shift suggests a recalibration of sentiment. Among the largest stakeholders, what once was a sell-off that pressured prices down has now become an opportunity, perceived as too attractive to ignore. The logic follows that by withdrawing more than 1 billion tokens from circulation and relocating them into private wallets, these whales are signaling their conviction that Dogecoin's next move will be upward rather than downward. Historically, such on-chain whale behavior has preceded substantial price appreciation, as whales possess the firepower to absorb sell-side pressure, restrict available supply on exchanges, and create a psychological floor that can embolden smaller investors to follow suit. Indeed, retail traders, ever eager to tag along with the big fish, often interpret these accumulation patterns as a green light to add Doge to their portfolios, amplifying buying pressure in a self-reinforcing loop. Moreover, the timing of this whale accumulation dovetails with a broader technical narrative. Dogecoin's price corrected nearly 8% over the past week, clawing back from momentum-driven highs in July, and in doing so dipped into oversold territory on the relative strength index, a level that in mid-June saw a comparable RSI reading below 30 spark a 70% rally within a month. The implication is that the current retracement may be the healthy consolidation that precedes another explosive move, with the whale's strategic buy-in providing the fuel for a potential rebound. If these giants have indeed laid a foundation by securing fresh tokens at discounted prices, the question becomes whether retail and mid-sized players will generate the follow-through necessary for the market to test resistance zones around 22 cents and 25 cents and beyond. Adding to the bullish case is the memecoin's enduring community passion, fueled by high-profile endorsements, meme culture, and the occasional tweet from influential figures, which often translates into rapid spikes in social engagement and trading volume when optimism coalesces. Should Dogecoin's network activity, measured by transaction counts and active wallet addresses, remain robust, it would further validate the whale's thesis that the ecosystem retains its vibrancy, providing a fundamental underpinning to the price. However, this narrative is far from unassailable, and there are several compelling counterarguments that highlight the risks inherent in expecting the recent whale accumulation to trigger a sustained upswing. First, the memecoin segment is notorious for abrupt volatility and for price hops that can as quickly reverse as they mount, driven as much by social sentiment and algorithmic trading as by on-chain fundamentals. A single misstep, whether it's an unfavorable regulatory pronouncement, high-profile hack on a decentralized exchange, or an abrupt change in macroeconomic conditions, could rattle the market, prompting the same whales who recently loaded up to start distributing into bullish rallies once again. Indeed, some skeptics argue that large holders may be engaging in a classic buy the dip, sell the rally strategy, intending to accumulate at lower prices only to offload their positions at the first sign of a sustained uptick, thus trapping late arriving bulls in a lethal short squeeze. The distribution of supply dipping in late July could have been the precursor to such a plan, with the recent accumulation serving as the final leg of a longer-term rotation strategy rather than a definitive bet on higher prices. In addition, the current price action around 20 cents is precarious, while bulls point to the 18 cents, 19 cents zone as a strong support backed by significant buy-side liquidity. Any breach below that level, perhaps triggered by renewed macro equity market weakness or tightening monetary policy, could see Doge tumble toward 16 cents or even lower, unleashing stop-loss cascades and margin liquidations that amplify the descent. The mere presence of large, long, and short walls on major exchanges can create artificial battlegrounds, where the price becomes mired in narrow ranges, frustrating both bulls and bears and deterring fresh participation. Volume expansion during the recent accumulation suggests caution. Genuine breakouts are typically accompanied by surges in trading volume, signaling broad-based investor conviction. Yet the current uptick in whale holdings has not yet translated into a noticeable uplift in overall liquidity. Furthermore, the fundamental landscape for Dogecoin remains mixed. While there are ongoing initiatives such as potential layer-to-scaling solutions, collaborations aimed at mainstream merchant adoption, and community governance upgrades, many of these projects are still in nascent stages, lacking firm launch dates or proven user engagement metrics. Without tangible milestones, the ecosystem's narrative relies heavily on nostalgia, meme appeal, and the speculative allure of what-if scenarios. Should these fundamental developments falter, or if competing networks deliver more compelling real-world use cases, the momentum that whales anticipate could fail to materialize, relegating Doge to the realm of fleeting hype coins whose rallies fizzle as quickly as they flare. Macro conditions also inject layers of uncertainty. If central banks maintain or escalate rate hikes to combat persistent inflation, liquidity in the broader financial system may tighten, leading risk assets, including highly speculative memecoins, to suffer disproportionate sell-offs. Conversely, a dovish pivot that unleashes fresh liquidity could propel Dogecoin upward. But such windfalls often distribute unevenly, favoring larger market cap coins like Bitcoin and Ethereum before trickling down to altcoins, and sometimes bypassing memecoins altogether if institutional risk managers deem them too volatile. The regulatory backdrop for cryptocurrencies remains in flux as well. Any adverse ruling or enforcement action, particularly in major markets like the United States or the European Union, could darken the outlook for all digital assets, rendering whale accumulation a lonely signal amid broader uncertainty. Sentiment dynamics, too, are a double-edged sword. While bullish narratives can galvanize retail investors and drive parabolic price moves, the same channels can swiftly reverse course. Bearish influencers or fear-mongering headlines can sow doubt, prompting a rapid exodus that overwhelms even the deepest whale wallets. The memecoin space is especially vulnerable to social media contagion, where a single viral post can trigger a stampede out of positions, negating the impact of on-chain accumulation in a matter of hours. Given this confluence of opportunity and risk, market participants who seek to engage must adopt disciplined strategies. Traders eyeing the potential upside from whale accumulation might consider scaling their entries, building a base position around the 20 cents level, adding incrementally as price holds above 18 cents or after confirmation of a higher low on shorter timeframes, and employing tight stop losses just below known support to limit downside. Profit taking could occur in stages, strimming portions of the position near 22 cents. $0.24 and 26 cents too. Capture gains while maintaining some exposure in case the rally extends. For those with access to derivatives markets, buying call options with strike prices at 22 cents or 25 cents can offer leveraged upside with defined risk, but the premium cost and time decay must be carefully managed. Longer-term investors inclined to trust the whale's conviction might allocate via dollar-cost averaging, reducing the risk of mistiming entries while building a stake designed to benefit from any fundamental advancements in the Dogecoin ecosystem.